Up. Before we speak to Mayank Agrawal, CEO at Gallantt Ispat, Varsha joining in with more details.
Well, talking about Q4, yes, there was a revenue growth which was led by, volume spike and capacity ramp up, but there was a margin pressure. This was due to, higher raw material and input costs, and also increase in finance costs impacted the net profit. Talking about the growth strategy, the capacity expansion target stands at around 12.3 lakh, million ton. Rupees 1,500 crore has been allocated for mining integration, and 300 crore is in plan for solar power expansion. Lastly, on the capex program, total capex stand at around 3,000 crore is being executed over the next 2 to 3 years. So yes, triggers are playing when it comes to the Gujarat debottling, and India's steel outlook also remains robust. But yes, margin pressure is one of the key things, which has led to the steady or I would say a weak performance.
Okay. Well, Varsha, thanks for that. Let's get in Mayank Agrawal, the CEO of Gallantt Ispat, on the show. Mayank, great having you. Thank you so much for taking the time out. This is Neeraj Shah here. Good morning. And as I read your presentation of the earnings presentation that you guys have given, what stands out is that you seem to believe that this is a decade of structural demand and not a cycle, which is very counterintuitive to how metals have behaved per se, right? It has always been a cyclical product. What gives you this confidence, and where, according to you, are we in that cycle?
So a very good morning to you and to your viewers, and thank you for having me here. So why we say that it is structured and it's going to sustain is that we are primarily into long products, and which is governed by the domestic demand and supply scenario. And with the kind of infrastructural push that we see, particularly in India and all addressable market where we are, which is Uttar Pradesh and Gujarat, we see a very robust spending on the infrastructure, which makes us believe that it is structural and it is going to sustain.
So here's the question, right? If I look at what you have done, Mayank, let's say, and I'll use a simple statistic, I'll not use cash flows, so on and so forth, but if I look at what effectively you've done in terms of revenue growth, EBITDA growth, etc., because those are the two key parameters that you want to look for a structural demand play, the numbers should have looked different from what they are looking from FY23 to FY26. You were at 4,057 crores March 2023. You are 4,400 crores growth, but okay. Even on EBITDA front, 3,700 crores, 369 FY23, 3,700 crores March 2026. What's happening?
So I will explain that in detail to you. When we talk about the volume growth, so the last year we defined the plan of the capex, which your rep was also talking about. And the capex investment started in FY26, which are bound to be completed in the FY25, which are bound to be completed in FY26 in H2. So the volume growth would be coming from that, as currently the installed capacities are pretty maxed out with the capacity utilization at about 86%, although we are targeting to achieve that beyond 90% in the ongoing financial year. But the volume growth would be coming in from the capex on the capacity addition that we are doing. If we talk about the EBITDA per ton and EBITDA overall, there has been a substantial jump year-on-year basis. I mean, where our per ton EBITDA in last 4-5 years has reached from about 5,000 rupees a ton to the FY26, which is currently 8,800 rupees a ton. That is 17.33% year-on-year basis. So I believe that per ton EBITDA of 8,800 is pretty remarkable as an achievement for the company on a long product.
Mayank, very good morning. Tamanna Inamdar here. Just trying to understand how you see the direction for the EBITDA per ton, because I believe there's this debottlenecking that you're doing in Gujarat right now of your upstream operations. Will that significantly improve your EBITDA per ton metric?
Definitely. Currently, with the total 3,000 crore capex, 1,200 crores is going into capacity addition as well as debottlenecking of the upstream projects, especially products where we see some improvement that can be done. So the capex is already on way, and it will all be completed in S2. So for the second half of the current financial year, we'll see the impacts coming in for that. Besides that, the 1,500 crore capex that we are doing in the mine development, which is scheduled to be completed by FY28, that is 2 years from now, wherein both the units completely will be fully integrated with mines, and it would make an impact of at least 2,000 rupees a ton on the EBITDA. So while we are driving the volume growth on one side from 1 million ton to 1.3 million ton, which is 30% in the current FY itself. And it's not a long story that we are talking about. It's a short-term thing that we are talking about.
Describe short-term, please, Mr. Agrawal. When you're saying short-term, what is the time range?
Short-term is all this 1,500 crore investment on upstream debottlenecking in Gujarat, and capacity addition would be completed in S2 itself. So certain units would be commissioned in Q2, certain would be in Q3. So Q3 onward, we will see the complete impact coming in. And going forward, with the mines kicking in, it will further add an EBITDA to the company. So overall, the margins are going to be improving definitely substantially, while on the other side, we are already driving the volume growth.
Let me just come to you.
Looks very...
Sure. Let me just come to you on the margin point. When you say improving substantially, because your margins did get squeezed by 200 odd basis points because of raw material impact, I suppose. Wouldn't that be affected because of West Asia crisis, etc.? What is the margin picture that you're seeing because of the two opposing factors, right? Raw material and import costs, or input, and then the debottlenecking that you're describing.
So while in the metal industry, we are all aware that the realizations are not in our hand. But having said that, what we can best do is to optimize our cost efficiencies to drive the volume growth, which would ultimately, definitely over a longer period, improve the EBITDA. So EBITDA, when you compare even with Q3 to Q4 in FY26, Q3 was about 7,800 rupees a ton of EBITDA, which has jumped to 8,800 rupees in Q4. And the overall EBITDA also for the entire year has jumped by about 6 to 7% in FY26 when we compare it to 25. So on a year-on-year basis, over the last 3-4 years, we have substantially improved our EBITDA margin, and we continue to do so. And that will definitely improve our EBITDA in the long run. Obviously, in the short run, currently with the raw material prices pressure due to various geopolitical issues will impact in the short term. But in the long term, we feel that driven by the cost efficiencies and the kind of infrastructural spending that the country is doing, we are very well positioned in the two main markets, which is UP and Gujarat, to encash the same. Also, not to forget here, which is very important, I would like to mention, is that the company is completely net debt zero, wherein there is no term loan.
Sure.
And in fact, in the last quarter, we have had some earnings from on the interest side.
Okay.
And this entire capex is being funded internally.
Okay. But I do want to ask about that actually, man.
On the working capital expense.
Sure.
Yeah.
I do want to ask about that because that was going to be cost, because if you look at that line item in the P&L, that seems to have to a certain extent affected the bottom line. So therefore, is that, as you describe, working capital led? Seemingly it is. And while you're setting this up and you're undergoing this debottlenecking, do you expect that that's going to be a little bit of a wobbly sort of a thing, or a volatile sort of a thing, till things settle down over FY27?
No, I don't think so really. Because, the 5-10% here and there, but not substantially.
So therefore, you don't anticipate that So will you say that will finance costs be more or less in this range in FY27 as well? And you're likely to see net debt zero as well?
Yes, net debt zero, we aim to continue the same because the current capex are already ongoing, as I said, and they are already planned, and we will most of it we will meet out from the EBITDA.
Okay. Just a last question. I think this will encapsulate quite a bit because you've described that your margin performance will be better in the second half as a lot of those tailwinds kick in. But if you look at FY27 as a whole, would you say that your earnings are going to be volume-led or margin-led?
It will be on the both sides, majorly volume-led, because in terms of upstream, it's only Gujarat where certain improvements would be coming in at the back end, but broadly volume growth, because the entire 1.3 would be commissioned in H2. So we'll get the half-year benefit there.
Fantastic. All right, Mayank, absolute pleasure speaking with you. Thanks so much for taking the time.
Thank you for having me. Thank you so much.
All right, KPIT